Hi, everyone, and welcome back to our latest edition of IR Insight Live. Joining me today is Michael Spector, Senior Analyst with Nasdaq IR Solutions. So today, with Michael, we're going to be talking about REITs.
Exciting, wonderful world of REITs.
So tell us, what are some of the current themes you're seeing with REIT performance?
Sure. So I think last time I was on, we were just getting out of 1Q. 1Q was a pretty volatile and lackluster period for real estate, primarily because we saw heavy yield back up. So when the Fed raises interest rates, investors usually flock to treasury yields because it's a more risk-off way to get alternative income. So the 10-year jumped up around 3%, the 30-year even higher. So it took some of the pressure off investors to seek out alternative income through income-producing equities like real estate. So a couple of property sectors have shined. Hotels have been big outperformers, primarily because of tax reform. Consumers have more money to spend on travel and leisure, and businesses have more money to send their people out on the road, and brand loyalty. So one of the big detriments to hotel REITs has been the fact that consumers have been really picky when it comes to hotel price, and brand loyalty hasn't really been there. So they're seeking out the best rates through OTAs, online travel agencies, and we saw a shift back to brand loyalty, which has been a big benefit for hotel REITs. Some of the better performing property sectors of 2017 and 1Q have pulled back. Towers with some consolidation in the wireless space. Data centers because they just can't achieve this crazy exponential growth that they saw in 2016, 2017. And storage due to oversupply issues in major markets. We saw a rebound from retail REITs, which is a pretty welcome sight. I think a lot of analysts were writing the retail industry's obituary, and I think it was a bit premature because the 1Q numbers are pretty good. So we saw an uptick in that property sector as well.
Okay. So just one other question today. So 13F filings were in yesterday.
Yeah.
Busy time.
Sure.
So what are some of the big themes you might be seeing there already?
Sure. Yeah, 13Fs are like our Super Bowl around here. Some of the key themes, last time we spoke about the reconstitution of the largest real estate index fund, the VNQ. The Vanguard REIT Index Fund is the VNQ. They changed their benchmark from the US MSCI REIT Index, I know it's a mouthful, to a new index that includes specialty REITs, towers, timber, and real estate services non-REIT companies. So we saw large sales as expected because it was a gradual process over the first half of the year and into July. It looks like the majority of that transition has been completed. So we saw large sales across any constituents of the US MSCI REIT Index, so they could make room for these new constituents. And another big theme was just REIT-dedicated investors continuing to focus on this bottom-up stock selection strategy. A large reason behind that is they manage large capital stacks for foreign institutions, so they have capital call requirements based on those relationships. And the fact that their U.S.-based real estate-focused funds have seen a lot of redemptions with yield back up. So now they need to be more aggressive when it comes to stock selection. So we've seen the turnover ratio of these firms greatly increase over the first half of the year. Continued retail buying. Retail investors want exposure to real estate, which they wouldn't ordinarily have the chance to do. REITs are a pass-through investment, so they're continuing to favor the asset class. And it's been a pretty interesting theme the first half of the year.
Wow. Thank you for that, like hot off the press.
Yeah, hot off the presses.
Hot off the filings.
Right.
So thanks so much. Thanks for joining us today, Michael. We really
me.
appreciate it. And thank you all for joining us today on the latest edition of IR Insight Live. We look forward to seeing you again next week in our next segments. Have a great day. Thanks.